Okay, good morning, everyone, and welcome to what is now the 51st edition of the Coffee Microcaps morning meeting. My name is Mark Tobin. I am the founder of Coffee Microcaps, and you're very welcome to anybody who's joining us for the first time, and for all our regular viewers and listeners, welcome to this morning's event. I'm just going to quickly run through some of these introductory slides, and we're going to get straight into it with our first presenter. First, I'd like to mention our sponsor for all our Coffee Microcap virtual events, Mayweather Capital. So Luke Winchester, who is probably well known to many of you in the kind of Australian FinTech community, is launching his own microcap fund. I believe they're just dotting the I's and crossing the T's and the PDS, and I think he's supposed to be launching, I think, November 1, or that's the aim. So please feel free to reach out to Luke and have a chat to him if that's of interest. Quick compliance and disclaimer. And just for anybody who is joining us for the first time, typical companies you have presenting on here every Thursday morning are companies with market cap under 300 million that are in revenue and approaching cash flow break even, or indeed, like both of our companies this morning, are already profitable outside the resources and biotech sectors. So what I call industrial microcaps, so that can be microcap technology names, microcap financial services, microcap healthcare. I just round them up into a catch-all group of what we call industrial microcaps. Structure the webinar for anybody joining us this morning. We've got two companies presenting over the space of the next hour, 30 minutes for each, which will break down into a roughly 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier to manage when we get to the Q&A part of the event. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. If you want to follow Coffee Microcaps, you can guess on Twitter is probably the best place. YouTube, where you can subscribe for all our content, including this webinar, which will be up tomorrow morning, and indeed all the previous webinars we've had. LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting ASX microcap every week, and you can get that on the Substack newsletter platform. Up first, we're going to hand over to Brad Thomas, CEO of Prophecy International. And then just after Brad, then I'm delighted to be welcoming Warren Hebard from iSelect, who's going to be coming on just after Brad. So without further ado, let me hand over to Brad. So I'm going to stop sharing my screen. Brad, if you want to start sharing yours.
Yeah.
I'll let you know when I can see the cover slide of your presentation.
Right, should be coming now.
Yeah, it's just loading now. Yeah, I can see the cover slide of your presentation now, Brad. You're good to go.
Terrific. Thanks, Mark. And thanks for having us on the show. Today, I would just like to take us through the investor presentation that we released to the market really only a few weeks ago now, and cover probably three main areas. One, simply who Prophecy is, where we've been and where we've come from. Two, what are the products that we have in market and the markets that we address. And I want to cover the great results that we've had in the first quarter and look at the outlook that we've got going forward. So Prophecy is a pure play B2B software company. We build software products and we take them to global markets through both direct and indirect channels. We've been operating in Australia for over 40 years. And in fact, we were founded in South Australia in 1979. And South Australia, Adelaide is still our head office, although I'm Sydney based. We have around 85 staff and we operate from 5 main offices around the world. Head office in Adelaide, where we also do all of the R&D for our Snare products. In Sydney, we have all of the R&D for our Mite products, as well as sales for Asia Pac. We have an offshore tech support center in Manila that does both tech support, some software development, and a few other training and back office functions. We have a number of folks in the UK covering the EMEA markets for us, and we have our largest sales organization in Denver, in Colorado, in the US. Over 80% of our revenue is generated from international markets, and a large percentage of that for both product sets is generated out of North America. Just a quick look at the details of the business. Last year, our revenues were north of 12 million. We've got good cash. We have no debt. As you can see from the chart at the bottom, we've been on a bit of a rise in the last few weeks based on some very good results we've had in the first quarter and some very significant deals. We've got a pretty healthy institutional investor coverage. This is pre the raise that we had in the last day or two. So that percentage has actually increased. And our market cap at the moment's in the 60 millions. Prophecy, as I said, has been around for a very long time, commenced in 1979, and built their own software that's gone through the normal software life cycle and has reached the end of its time. And after that, the company started acquiring additional companies. And I think the two ones that we need to focus on at the moment, Intersect Alliance, which is the Snare business, which was acquired in 2011, and then Mite, which was acquired in 2015. And in 2017, we sold off a few of the older businesses that didn't really have a significant growth opportunity, and we've focused entirely on the Snare and Mite product suites. And I think the thing that most interested me in joining Prophecy was simply the blue chip customer list that the company had at the time and continues to attract. I think one of the things that I am proudest of is our ability to, on a monthly basis, sign some of the largest companies and government agencies in the world to our products. And I think that gives us a very significant opportunity going forward. One of the things on this timeline is the largest SaaS deal that we've done as a business in signing Humana. I'll talk more about Humana and the attributes of that deal as we move forward. So we have two significant products that we take into market, and at heart, both of these are data-based products. So Mite is focused on what we call CX intelligence, or customer experience intelligence, taking the data from multiple systems, applications, and processes used to deliver customer service and customer experience by our customers, and taking that data, ingesting it, correlating it, normalizing it, running algorithms and calculating KPIs, and then enabling customers to visualize that in any way that makes sense for their business. Snare is effectively a security data business where we collect security event data from customers' networks. And again, we collect it, we correlate it, we normalize it, we make it available for analysis, reporting, and alerting. And particularly for Snare, Snare is used for achieving regulatory compliance, threat hunting, and forensics, whereas Mite is used for delivering exceptional customer experiences. But at their heart, it's all about collecting data, turning that into information that can be used by businesses to effectively protect their business or to improve their customer experience and customer service. Both of these markets are incredibly big. The cloud contact center market, which is our primary market for Mite, is better than 10 billion. And the cybersecurity market is just so huge that everyone is incredibly interested in anything that's got cyber in the name. We kind of sit in two subsections of that market, which are still very huge: security analytics and log management and event management. And both those markets are multi-billion-dollar per annum markets and growing at better than 10% compound annual growth rate. And the same in the cloud contact center space, very fast growing. And there are significant multi-year trends in both of these markets that we're taking advantage of. So here's an example of the Mite product, and really it's about ensuring businesses are as efficient as they can possibly be in delivering customer experience to their downstream customers. We're very much focused at the enterprise space, large enterprise, looking at 500 contact center seats and above is really the market that we're focused on. And that's a market that has very sophisticated and complex requirements around analyzing the customer experience they're delivering to their customers. And as you can see from these dashboards here, this one shows that we're pulling in data from multiple different systems and displaying it all in one visualization. So there's Salesforce data, there's data from Genesis, there's data from a ticketing system like Zendesk, there's data from survey tools like Survey Dynamics. And not only can we display these standalone side by side, but we can actually combine the data to run a KPI over the top that might be something like, instead of just understanding how many minutes my agent was on the phone for, I want to understand what's the revenue per minute that my agents are generating, or how many service tickets are being closed on the first call, or what's the average number of calls to close a service ticket. So it's taking fairly dry operational data and turning it into something that's really valuable for the business. And we've been successful in attracting some of the largest companies in the world through our partnerships with both Genesis and with Amazon for their Amazon Connect product. We've got a couple of key growth opportunities with Mite. As I said, we have very strong partnerships with both Genesis and Amazon Connect. We really focused very much on organic growth at the moment, and most of our revenue is coming from new logos today. And that's still a huge focus for us, particularly as there are significant numbers of customers looking to migrate from legacy on-premise contact center solutions to cloud-based systems offered by Genesis and Amazon and others in the market space. We feel that Genesis and Amazon are the two biggest players at the moment, and we're certainly getting very significant opportunity with those two. I think the ARR growth that we achieved last financial year, moving from 4.3 to 7.6 million, up 77%, is a great indicator of the success we're having there. But we've also had an exceptional Q1 with this product, adding another 3.2 million of sales and taking our ARR up to 10.2 million, with much larger deal sizes as we're capturing larger and larger customers. Absolutely fantastic momentum in that business. And one of the reasons we're incredibly excited about the Mite product. Snare, on the other hand, is a different style of product. The Mite business, by the way, is a completely SaaS business. It's mostly hosted on Amazon and Oracle, and we provide that as a fully managed SaaS service. The vast majority of our revenue is subscription, although there are some professional services. But the Snare business, given the nature of the data that we're collecting and the way that customers want to store that data, and quite honestly, the huge amount of data we're collecting, the vast majority of our customers on the Snare side still buy Snare using a perpetual license model with an annual maintenance payment. And Snare is a suite of products that sit out on the endpoints of the network and collect security data for analysis, and then we encrypt that, we filter it, we truncate it, we send it back to our key product in this product suite called Snare Central, which does a number of things. It stores data for as long as your compliance mandates require, 7, 12 years, depending on the requirements that you have, depending on your industry. We run reports on it, we do alerts on it, we make it available for search and forensics. And it's really a way for customers to meet compliance, to hunt for potential threats in their network, and to ensure that if the bad guys get in their network, they're looking out for potentially malicious behavior inside the network, so they can understand that there is someone doing something that they shouldn't be doing, whether that's an outside attacker or someone inside their environment. That's really what Snare does. It helps you find the activity in your network that shouldn't be there. Again, we have a number of significant growth opportunities for Snare. We have a strong and growing footprint in the defence and military and federal government sectors as well, particularly in the United States. Pretty much every arm of the US military and all the big defence primes are customers of ours today, and there is significantly more opportunity in those segments for us, and we are very well positioned to pick up significant business in that segment throughout the course of this year. We have some of the largest system integrators and MSSPs as our partners today, particularly the likes of NTT, Verizon, Fujitsu, specialist partners like Vambrace in the defence segment, and we intend to continue to expand our footprint within those existing partners, as well as recruiting new partners to take the Snare product to market more fully across the world. And we have a very significant upsell opportunity inside of our existing customer base. We have over, well over 3,000 customers using Snare. Some of those are very small, using a very small amount of Snare today. And there is an opportunity for us to, and they're not using Snare Central, and there is an opportunity for us to sell Snare Central to those customers. And that's a minimum $30 million revenue opportunity just inside our existing customer base. And then finally, we see that there is an opportunity for some segments of our market to convert Snare to a subscription revenue offering as well. I don't think it will ever be a full SaaS solution, but we've certainly made Snare available as a hosted solution, and Snare will run in Azure, Amazon, and Oracle Cloud today. And we have customers running Snare in the cloud today. And there is an opportunity both in the partner opportunity and with some of our commercial customers to move Snare to a subscription offering. Again, we've had a very strong Q1 with Snare, $2.2 million of new perpetual license revenue in the first quarter, which is up 46% against the same period last year. Some very significant wins. If I look at the deals that we closed in Q1, Commerce Bank, Yum Brands, MetLife, Worley Parsons, Interactive Brokers, the US Treasury. We have blue chip Fortune 2000 customers for Snare, and we continue to attract those on a monthly basis. So we're very bullish on the opportunity with both Snare and eMite. I think before I move on too much, it's probably worth talking about the Humana deal that we also announced in the end of the first quarter. This is the largest SaaS deal that we've done with the eMite product. Humana is number 41 in the Fortune 500. It's a huge health services and health insurance provider in the US. And we've sold eMite into their contact center environment, and they are a 25,000 seat contact center. The dynamics of that deal are that they've signed up for a 3-year contract with eMite, and they're paying us approximately $1.8 million per annum as a subscription for the eMite product and over each year of the 3 years of that agreement. And it's certainly the largest deal that we've ever done with the eMite product. And it's a great demonstration of what we're capable of, not just with the product, but also with the capability of our business to build a robust, scalable offering that can meet the needs of the largest contact centers in the world, can meet the security requirements of heavily regulated industries like health, can meet the global 24/7 support requirements of the largest companies in the world. And we have a sales organization that's capable of winning multi-year, multi-million-dollar deals in the Fortune 500. So I think it's a fantastic demonstration of the capabilities of the business and something that we really need to leverage going forward. I think on both Snare and eMite, we have a significant opportunity to accelerate our sales and marketing activity and simply have more quality conversations with more customers, which should translate into more sales, more revenue, and a better valuation for the business going forward. To look at the ARR growth in context, when we acquired Mite in 2015, it was a perpetual license on-premise, very complex product that required lots of consulting. And we transitioned that product to a SaaS product and targeted it at the contact center market. And as you can see, we've been very successful in growing the subscription revenue for Mite in particular, hitting 10.2 million at the end of the quarter. And outside of the Humana deal, there was also very significant other deals done in Q1. Companies like Amica Mutual Insurance in the US, which is a 2,000 seat contact center, and even here in Australia, we sold Mite into Lion, big brewing concern, and into Sonic Health in Q1. So we continue to attract great names and great customers on the Mite side, growing that ARR very aggressively. We've kind of covered most of this through the course of the presentation, and I know we're getting towards the end of time. I think the important thing to take away from this slide is that we have got a very strong pipeline for the rest of this year, and we haven't emptied the pipe out at the end of the first quarter. In fact, there is a lot more to come, and more opportunity to be addressed by expanding, increasing both the coverage capability and capacity of our sales and marketing organization. So really the things that we are absolutely focused on in ensuring we deliver growth in the business is we really do need to scale and optimize our sales and marketing activity globally. We do sell into many regions, and we do need to expand out, particularly in North America. We need to continue our product innovation. We delivered a number of strong product offerings in the last 12 months and have a strong roadmap going forward. And I think there's the opportunity to accelerate some of that product capability, given the fact that we've just completed a capital raise. We'll use some for that. We continue to look at operational efficiency of our business and make sure we're running as efficiently as we can. But we have demonstrated our ability to sell fantastic products into the largest customers. And we just need to do more of that and have more conversations with more prospects and make more sales. So I think as a business, there's a number of awards that we've won over the last couple of years, but really what we've got is diverse revenue streams that don't rely on a small number of large customers to deliver our revenue. We've got very large addressable markets that are growing. We are absolutely pursuing acquisition opportunities in the marketplace as well, and definitely looking out for acquisitions that make sense in line with our two current product sets. We've got blue chip customers around the world, and we are targeting profitable, scalable growth. And I think the key there is profitable growth and expansion of our subscription-based SaaS businesses. And we have a strong position in all of the markets that we operate in, and very strong market trends that we can benefit from over the next few years. And I think that wraps me up for the presentation, Mark. So I think we are open now for questions.
Yeah, we had a few that were emailed in ahead of time, and I see we've got a good few that's come in as you've been going there, Brad. So let's dive straight into them. And apologies if I don't get to everyone's question. We might just run out of time. The first one that was emailed in ahead of time: what's the payment terms for subscription revenue for Mite? Are customers committed volume paid monthly in arrear or in advance, while the usage-based revenue is paid in arrears?
Look, there's multiple depending on which market we're selling into. If I use the Genesis model as an example, customers pay a per agent per month pricing model, but our customers are committing to a volume and a term. So if you're a 100-seat contact center, if you've got 100 agents taking calls in your contact center, and you've got 100 seats of the Genesis software, then you need 100 seats of Mite, and you'll commit to a 12, 24, 36-month term for 100 seats. And that can be either invoiced monthly or annually in advance, and then we charge any overages. So if they they burst up to 110 users for a particular month, then we capture those additional 10 users in arrears.
Okay, great. And then the second question, a little bit technical, but I'll read it out here. The 7 mil cap raise can fund a substantial step up in team size. In considering FY21, the company only had an OPEX of about 14 million. How fast do you plan to ramp up OPEX, or is it part of a planned acquisition strategy? Does this mean the company will be no longer cash flow positive in FY22, which was commented, I think, in another presentation you were doing last week?
Yes, look, I think the key for us in the short term is making some targeted investments, particularly in revenue generating areas in sales and marketing. I think with the success we're seeing with Mite in North America, ramping up the sales and marketing activity there, adding new sales resources is the immediate short-term goal. And there are also some things we need to do in addressing the market opportunity we have with Snare. But the first priority is taking advantage of the momentum we have with Mite. On both our products, there's also opportunity for us to accelerate things like the introduction of artificial intelligence and machine learning into both of our products. That's something that we're moving forward with now, but we're doing at a measured pace, and I think we can accelerate that. So there are a number of areas in the business that we can use some of the capital we've just raised to do things a lot faster, and that's really the process we're going through now, is just identifying exactly what investments we're going to be making in the short term, particularly this year. And I don't think we're certainly not obliged to spend all $7 million immediately. We're not going to throw good principles of business management out the window. Our strategy is still for profitable growth, and I still think we have the ability to be both cash flow positive and EBITDA profitable at the end of the year, despite the fact that we're going to make additional investments.
Okay, great. I'm just going to take some of these ones that have come in now. The sales pipeline that you referenced for Snare and Mite, is that annual recurring revenue or a total contract value number?
On the Mite side is really the only subscription side, and that is effectively annual recurring revenue, although there is a small amount of setup fees and professional services in that 13 million as well. Of the 13 million, there's probably $1 million of services and setup fees. For Snare, it's all perpetual licensing.
Okay, great. What is the sales lead time and how has that changed, if at all, over the last 12 months?
It hasn't necessarily changed over the last 12 months, but the dynamics of the market have changed, particularly for Mite. When we started selling into that market 5 years ago, was very much an SMB play, and we could close deals very quickly. As we've migrated with the market to delivering to enterprise size customers, then obviously those sales cycles slow down. There are more decision makers, there are more requirements to be ticked off, and typically, a very large deal for us is probably a 6 to 9 month sales cycle.
Okay, great. Are the contracts, and they don't reference which one of the products, are the contracts tendered? Who does Prophecy compete against in the tenders, if indeed they are tender offerings?
Really, the only place that we get involved in tenders and RFPs is in the government space in the US. Most of our other deals are just done through sales activity. Occasionally, there are other competitors. On the Mite side, customers will often look at the reporting tools available from the contact center vendor. They'll often look at other traditional BI tools, and there are competitors even in the ecosystems that we operate in with Genesis and with Amazon. There are other App Foundry partners that do analytics solutions in the Genesis ecosystem. But we are the only platinum partner, we're the largest analytics partner, we're the only partner with the proven ability to scale to a 25,000 seat environment and deliver the security and scalability requirements for enterprise. So we've established a leadership position with Mite, and it's up to us to maintain that now. On the Snare side, the security market is huge. It's crowded. It's very competitive, but it's also very fragmented. And over a number of years, we've established a very strong foothold. We have good credibility in the marketplace with the Snare product. We just need to get Snare in front of more customers. But typically, it's any of the security analytics products that we come up against. Maybe it's a SolarWinds, maybe it's a Logarithm, maybe it's Sumo Logic. There are a number of players in this market space.
Brad, we're just up on time, so unfortunately we're going to have to leave it there. We didn't get to all of the questions, so I would encourage people, if I didn't get to your question, apologies, to get in touch with Brad. His contact details are there, and I'm sure he will get back to you in due course.
Thanks very much, Mark.
No problem. Brad, if you could stop sharing your screen, please, because I know Warren, our second presenter, is waiting patiently to start on his presentation. And if you can just go to full screen, there we go. If you can go back to slide share mode, please, Warren. Yeah, there we go. Perfect. You're ready to go, Warren.
Thanks, Mark. And thanks for having me here today. Just give a quick update on the overall business before I get into the strategic outlook for the business, and before I get into an update on the financial results, just a bit of an iSelect 101 for those who aren't familiar with the business. This business was founded back in 2000 and grew out of a need for comparison of complex products and how to simplify that for the consumer. The proposition has remained very simple and consistent over the journey of the business. We're here to save consumers time, effort, and money on their household bills. The primary purchase decision driver for consumers to engage with iSelect and use the product and service is ultimately to save money. And that's a key benefit of what comparison delivers. Each year, millions of Australians visit our website. Our primary verticals, as we call them, first health insurance, which is over 50% of our revenue. That's then followed by energy, which is comprised of electricity and gas, followed by telco. We then have general insurances, life insurance, and then we've also just moved back into the financial services sector with credit cards and personal loans, and are on a path to expand the number of verticals. The timeline, the history of the business, it was founded way back in 2000, with health insurance, life and car insurance were added, home loans, broadband, energy was launched. The business IPO'd back in 2013, and then I joined the business in April of 2018 in the capacity of Chief Marketing Officer. That role was then expanded. I was running the wealth division, and also we centralised the commercial function, so it was a role of Chief Marketing and Commercial Officer. I've taken the reins as CEO just approaching a year, which was on November 1st last year. The business has a market cap of $75 million, net assets of 111, revenues in FY21 of $111 million. We run about 1.7 million comparisons a year, and orders served for about 157,000. The net assets, the composition of those is an interesting conversation, and where we land. We've got a trail book of forward cash receivables worth around $120 million. Oh, it's 124.8. That trail asset is returning over 100 cents in the dollar. It's a fantastic asset. We're currently trading below NTA, and at the risk of sounding cliche like most CEOs do, we think we're significantly undervalued based on that asset alone, let alone where we see the future for this business going. Last year in FY21, we delivered an underlying EBITDA of $20.8 million. That was inclusive of $3.4 million of JobKeeper. The year was an interesting year. Certainly is a really resilient business. We haven't been net beneficiaries of COVID and lockdowns, but certainly been able to trade through it. But we've seen some pretty significant fluctuations in customer demand across all the different verticals we play in. But certainly, as we see things start to normalise going forward, we're very much looking forward to the external environment being a bit more stable. But regardless, COVID's not a killer of this business. We're just not a net beneficiary either. We've had a really successful prior year with new partnerships. Part of our strategy is to diversify our lead sources, and we see this as one of the pathways to growth, as well as the addition of new verticals. We've done some deals with News Corp and 7 affiliates, which are lead generation deals, and we've also got others that we're currently scaling in the digital space. One in particular, a high value that's growing at a sensational rate at the moment. But conversely, we've also had some COVID pressures on the business as well, which in H2 we're still feeling, H1 FY22, still feeling a little bit of those pressures for some of our supply chain for lead generations. Last year, we launched the new verticals of business loans, credit cards, personal finance, and car loans, and we'll be looking to expand upon that with 2 new verticals in FY22. We've got a great balance sheet. We've got no debt at June 30th, $9.4 million cash in bank. Cash flows remain sound. Trail asset cash collections, as I mentioned, are certainly performing ahead of expectation, and a current market cap of $75 million versus the trail asset. The trail asset alone, when you engineer it back to a per share, it's 57 cents a share, and we're trading at around 35 cents a share at the moment. So on that basis alone, we've got a range of deep value funds that sit on the register, and that's a primary driver, but we're certainly now out to tell the market about the opportunity that's ahead of us going forward with our strategic direction, and really excited today to talk more about that. What we see as the vision moving forward is really capitalising on the consumer data right opportunity that's in front of this business. For those who aren't familiar, I'll spend a bit more time today talking about the consumer data right at a higher level, but specifically for this business, we've got Open Energy set to launch in October of 2022. The first 3 providers will be entering the market. That's really exciting for us. We see it as an opportunity for us via open data to really change the way comparison is delivered for the consumer. And ultimately, we see an opportunity here to grow the total switcher market, not only for this business, for the category. It's what it'll enable through Open Energy is the ability for us to simplify and automate a lot of those user journeys. Those user journeys at the moment, by and large, are driven by the consumer coming to iSelect through our website, doing a manual data entry process, which we call a needs analysis. Our algorithm then produces a comparison based on their needs. Open Energy will effectively automate a lot of that process. What it will do, the providers are required to share the underlying data that's associated with their energy usage. We can then ingest that data in an automated fashion via a click or 2 with consent from the user and automate a lot of that process. So it's really excited the path we're going on. And for us at iSelect, we think we truly believe we're exceptionally well placed for the Open Energy opportunity on the basis that we've got an end-to-end energy journey that we own through the sales process, working with the providers, an amazing panel of providers with all the key brands in the market as well. And a lot of the competitive set is only partway there with that energy experience, and many of our major competitors outsource part of their model in the energy space as well. So FY22 is about setting up for success and investing in the development of that new customer journey and those user experiences. And then we are on track to launch in Q2 of FY22 in line with the timing of Open Energy going forward. What Open Energy is, to simplify it, and what the CDR is important to know. And what we've found since we announced the Horizon 1 of our FY26 strategy at the full year results is the market has a pretty limited understanding of the consumer data right. and what that is, and also the next level in the second sector, we had open banking, which I'll talk to as a reference point shortly, as the first sector was launched, and open energy being the second. And the market, our current investors and those interested in our business, the knowledge level is at a low base, and we've got a really important job to do, like we're doing today, to educate the market more broadly, not only about CDR, but about the opportunity that's aligned to this business. So what is CDR? Ultimately, it's going to give consumers more control over their data. It's designed to give consumers greater choice and convenience through simple and easy to use processes, which are predominantly going to be digital. It's an economy-wide reform that was rolled out and will be rolled out sector by sector. It was previously sitting with the ACCC. It's been moved into Treasury. It's been rolled out for banking, and the second sector is open energy. It's an exciting phase for us. What it'll do is really improve the consumer's ability to compare and switch products. And it's going to encourage competition between the providers themselves. And then also, like you've seen in open banking, lead to far more innovative products and services that will be delivered by third parties such as iSelect. So that user experience for us at the moment, energy takes around 30 clicks for a consumer to convert through a comparison journey into a sale. That'll be significantly reduced by far less than 50%. Ultimately, we want to get to a model where we're somewhere close to what Amazon does with one-click purchases. And why is that? It's the best test case or user case in the world that talks about continuation rates and propensity to convert when you can simplify the user journey, and they've mastered it through their e-commerce platform. We like that. The less friction, the higher propensity to convert, the more the customer loves you because of the easy use. And that's really where we're headed, to automate a lot of comparison. What it will also enable us to do is move comparison. Today, it is driven by point-in-time engagement from the consumer. They come to the website, they enter their data manually from a bill or via a phone call. We enter that on their behalf through a conversation. We then complete a comparison based on point-in-time data that's provided. Open Energy will provide access to third parties via consent from the consumer, which is really important, like iSelect, access to their data and usage on an ongoing basis. So what we'll be able to do is, the consumer might be on a monthly billing cycle, they might be on a quarterly billing cycle for their electricity. We will ingest that data automatically after they've given us consent for a time period, and then feed back to them what their actual savings again can be based on new partners or new deals we've got on the panel that month or that period versus their actual usage, and push that data to them straight through the product. So it gives us the ability to really create that ongoing relationship with the consumer and move away from the transactional nature of the business as it stands today. Open data, is a really good case study to look at as well. It currently is enabling many innovative customer experiences and user journeys. We've got telco likely to follow in the coming years, as will the general insurances, and we're lobbying hard for private health insurance, which still is our main game, to be added, and are going through that process at the moment. But the case study for open data and open banking is interesting to look at in terms of the adoption curve, in that you've seen many fintechs enter the space. There's 19 accredited data recipients at the moment. 3 of the 4 big 4 banks are the data recipients. We're currently going through that process. What it's doing is enabling these customer journeys that remove a lot of friction, like budget tracking. And I think the best example in market that's currently the most scaled is credit card application switching, which by and large, a lot of the experiences you're seeing now are powered by open banking and the consumer data right, which in essence, you can have your current providers' statements and information scraped via a single click, rather than the consumer, if they've got 1 or 2 credit cards or even more, having to spend time to download 3 or 4 or 5 or 6 PDFs, upload them into separate systems, which may take 10 to 20 minutes to half an hour. It's all done by a single click, so it reduces the friction and high propensity to convert. And look, in the mortgage sector, you're seeing back-end services that are also being highly effective as well. So open energy for us, that consent process will enable consumers to get started easily via a click or two, and enable the access to data for us and remove that manual entry, as I've mentioned. It's going to give us the ability to give that real-time data access against their actual usage, which is really important in terms of accuracy and being able to create that relationship-based product and experience. And I've already touched on, the amount of clicks we can reduce this friction continuously. Where we want to get to eventually over our long-term plan is move not only into this auto comparing model, which will enable continuous comparisons to run on behalf of the customer in real time as their bills land. The long-term vision is to move to auto compare, then auto switch. And you've seen some models in the UK with the likes of Go Compare, which have had that comparison as a service, as we'll call it, model, which is consent driven by the consumers, not only to run the comparisons on their behalf ongoing, but to auto switch them and keep them on the best deal in real time. So we think that's a really exciting opportunity, and not a path that we have to forge and create, because the template exists in some of the international markets as well. Our business as it stands, we believe we're best placed in this market by some way to capitalise on the opportunity for open energy. We've got the legacy, we've got the customer base. With the customer account investment and the data infrastructure we've invested on, we're growing customer accounts rapidly. And if we marry up that customer data information we have from the account information with open energy, the amount of friction we can reduce out of the experience of the customer to ultimately convert to a sale is really significant, particularly versus, I'm sure some of our competitors will go along this journey but don't own the customer information as well. So they're coming from quite a way back compared to where we are as well. The market opportunity to grow the category is significant. There's the tax out there that consumers pay by not switching, and a lot of it is driven simply by the friction of too much hassle and not having the time, and it's too confusing. And our core proposition is really to solve these consumer friction points and deliver value to them by saving money. So there's a big segment of the market that pays the inverted commas lazy tax, and 74% of consumers out there and are sitting with their current providers. So the job at hand of us is to change the model, reduce the friction, improve the experience to access that data and reduce the lazy tax that Australian consumers are currently paying at the moment. That's it at a very high level across the business, Mark, but I'd love to dive into some questions and go for now.
Yeah, we've got a couple of questions coming through already, Warren, so I'm going to jump straight through them. First one is, how secure is the trail income? I guess what's your kind of legal right over that trail into the future?
Yeah, certainly. So our trail asset, I think the reference point I give there is the cash collection on the trail asset. We're collecting, well over 101 cents in the dollar. It's up to 102, 103, 4, depending on where we deviate, half on half. There's a level of conservatism built into the balance sheet view of the value of that trail asset. And really the significant shift was when we had the accounting standard change to AASB 15. The trail asset and the cash collection behind it prove the value of that asset. And it's an amazing asset that, underpins the value of this business.
Maybe just one from me before I go to the next one. In terms of the length of the trail, if you stop new business today, how long would it take to, I guess, run off the trail income? What's the kind of lifespan of it, if you know off the top of your head?
Good question. Look, it varies because the business is 21 years old. There are some perpetuity legacy agreements that go in perpetuity. So some people view the length of the trail as an issue, but those agreements, now that they're running in perpetuity, are amazing deals. They don't exist in the market anymore. So there's a few lenses to look at this. I mean, some look at it, you reduce the risk, the shorter the trail cash collection, the better. Because of the nature of this business and the longevity of it, there are some of those legacy books. There's others where the trail cash commission rolls out over longer periods, like we've got a trail asset in life insurance, which is regulated, the percentages that can land each year, which runs a much longer time period, whereas the most up-to-date health books will run over a 2 to 3 year period. So we've got a diverse spread of the length of the trail assets just based on the legacy of this business as well.
Yeah, so it's also based on which vertical it originated in as well, by the sounds of it.
Exactly right. Exactly right. Now split is, a home loans book's only about 4 or 5 million. The life book's around 40, and the balance is made up from the health book, which the majority of that is on a shorter trail cycle now, but there are some legacy books in there because the nature of how old this business is, but they're collecting well.
Yeah, I'll leave that to the actuaries to maybe work out a definitive answer. Okay, let's jump on to the next question. Has CTM, I presume that stands for Compare the Market, made any comments on CDR either here or in the UK?
No, we haven't heard any comments directly from the team at Compare the Market around CDR or what their strategy is or their vision going forward. So we're not aware. I mean, if you look at the GDPR in the UK, there's varying degrees of how it's being utilised by the category. We think we can be market leading, global leading, because of the nature of how this market operates, particularly in energy, and in some ways, our jurisdiction could be simpler than what the GDPR is because of the way the products are constructed and the way we've regulated it. So that's an exciting opportunity for us.
Next one, the alternative lead sources with these partnerships you talk about, what proportion of your total leads can these make up in the next 12, 24 months? And how does conversion compare to traditional sources or I guess longer partnerships that have been in place for a longer time period?
Yeah. Firstly, on the split of volume, we don't put that out. There's a lot of IP in the way we split from our spend on Google, what brand drives, what these alternative deals drive. So we'll keep that commercial in confidence for now. Conversion rates vary, but ultimately what we look at is not just the conversion rate, but the overall ROI. So commercially, how have we structured the deal? What are we paying on a cost per lead or cost per converted sale at a CPA? So we look at they vary, and there's a spectrum across there. By and large, inbound brand-led leads convert the best, but also the cost of acquiring them and building equity in the brand can be expensive. So they vary, but ultimately we've got really strict controls around managing the ROI of the source and the conversion, ultimately the revenue outcome in real time. So the governance and IP around that is really strong in our business.
How much CapEx and OpEx will be required to adapt the business for open energy and indeed the other verticals to have a more Amazon-like experience?
Yeah, look, we're going to release the open energy experience within the existing CapEx and OpEx budget. So FY22 will be around 5 million CapEx, give or take, probably single digits or just on double at the most in percentage terms. And then OpEx being pretty similar as well. So call it 5 and 5. That will be contained. We've just done a really strict prioritisation process so we can focus a significant amount of that investment for future state and what open energy will deliver. Beyond there, to get there from a platform perspective, a conversation, is warranted on what's required at a platform level, to take this business to the next level and open up further opportunities for the longer term strategy. But we're focused with the board at the moment on running to the first horizon of our strategy, which is over the next 12 to 18 months, which will operate within the existing CapEx and OpEx budgets.
Great. And that you mentioned longer term strategy. Question on strategy: are acquisitions part of the growth plans going forward? And if so, what would be kind of the general criterion?
Look, we're in the market in terms of M&A, and certainly it's something we're always considering. We're looking for deals that will be accretive, and there's a whole range of categories we look at there, and they might be like-minded businesses, adjacent businesses that can drive value through brand or lead generation. Where there's technology, we look at those as well. So certainly we're considering options in that space and continue to do so, as we always do.
Okay, great. Next one, back to the trail again. Has the company looked to monetize the trail asset at any point? So I guess somebody wants to pay up 95 cents in the dollar, for example, and it's today rather than having to pay it over the next 2 years, for example?
Yeah, look, it's a consideration we think about regularly as we are at the moment, particularly because we're trading below NTA. And if you look at what we could do to extract some value for shareholders in terms of putting that cash on the balance sheet, or looking at how we expand the capital management program we've got going now, possibly. Yes, they're considerations we think about regularly at the moment, particularly given where the share price is trading. It's a conversation that we engage with our existing shareholders on, and a process that may run depending on the appetite of shareholders and also relative value versus NTA, and also if we can extract some value out of that asset in the near term, it's something we'll consider.
Okay. Does the use of the partnership model for lead gen mean that you'll improve your marketing ratio as a percentage of revenue?
Look, it may. Look, marketing as a percentage of revenue is an interesting dynamic, and we've really guided the market on this because it blew out quite a few years ago and we needed to contain it. But what we do know through some of the competitive set is you ideally, in principle, you'd like marketing as a percentage of revenue as low as possible. But a construct of the P&L means some of the dynamics in the category mean that competitors who have lower overhead costs or lower tech costs they're covering, for example, can compete harder by having marketing as a higher percentage of revenue. So it's dependent on the construct of the overall P&L, and if we can get efficiencies in one area, we may look to further invest to drive more competition into the media channels we're playing on, to drive volume at a profitable level. We're going to be doing it responsibly. We certainly won't be looking at unsustainable and unprofitable growth, but there are options there for us to compete harder, which may drive marketing's percentage of revenue up, which we're considering at the moment.
Does doing deals with Prime and News Corp exclude you from doing a deal with Nine? And if I can just maybe tag on to that person's question, would your answer kind of be broadly similar for other verticals? If you do, a deal with Bupa, does that exclude you doing something with HCF, for example?
Yeah, look, I'll start with the second part of the question first. No, none of the deals we do with providers are exclusive. The nature of our business means the broader the panel of brands we compare, the better we convert. So they're non-exclusive, and all the partners are always aware of that. That's the model. That's our business. The media deals and lead gen deals we've got, there are elements of those deals that are exclusive, but they don't preclude us from dealing, in traditional sense with providers that sit within their categories as well. So, but the exclusivity around them is, it's relative to aspects of the deal, but you'll see our ads running on 7, 10, 9, etc. in a traditional sense, but they're just aspects of these lead gen models that are exclusive in nature in some aspects.
Okay, then what share of the market are you, and how does that compare to the UK market for similar business or similar models?
Yeah, that data isn't available for our market because the lion's share of our competitors are private entities, and we don't have access to their financials. It's not a category where all the competitors are listed and we can get an actual market view. There's aspects through some of the APRA data, etc. we can look at, but yeah, it's not. I couldn't give a very accurate picture here that I'd be comfortable with sharing here and now.
Okay, no problem. Warren, I think I just want to go back through here to make sure I haven't missed a question. No, I think we've tackled them all, and we're coming right up on time as well, which is great. So I think we'll leave it there, Warren. Thanks for taking all of those questions, and if anybody does have any further questions, Rowan's details have been up there. Please make note of that. If you want to get in touch with him, or indeed with Warren, you can chat to Rowan. And with that, I'll end this morning's meeting and wish everyone a good rest of their Thursday.